Okay, so let's look at our stock market calendar. We're right before a holiday. Okay, so September 4th is Labor Day, so I expected around the holidays to be festive occasion. Usually the markets are up around then. But now we're actually in a point in our stochastics where we're overbought. Believe it or not, in 2 weeks, we went from a period of oversold to overbought. So right now, the stock market is, usually whenever it's overbought, it stops going up. So that's very interesting because 2 weeks ago it was down and everyone was selling. Now, we have no earnings right now to look forward to in September. We have a Fed meeting date, end of September. We have end of quarter wind adjustment, which is usually makes the last week of a quarter positive. And the 15th, we have triple witching, which is kind of a scary time for a lot of people with stocks going up and down a lot. Okay, so right now we're overbought. So there's a very good chance that the stock market pulls back in the next week or so. That's why I have it red right now. So we have, looking at all of our indexes, we're overbought in a lot of them. So you can see we're over 90 in the stochastics. We're halfway between the overbought and oversold. Interesting thing happened at the beginning of this week. We had, let's look at our calendar. 28th and 29th, 80% up days for the stock market. So that's a very good indication. There are some theories that when you have positive 80% or 90% up days, that's you have those in combination. It's a good indicator of momentum. But we're overbought right now, so almost every one of our stochastics we're following for indexes are overbought. You can see right there, right there, right there. And it follows through with the stocks also. Healthcare isn't overbought, but all right. So let's take a look at what's going on in the stock market. We have like a little formula here. I don't want that. But everyone in the stock market that's rooting for the stock market to go up is watching jobs reports, because if you have a strong labor market, the Fed is going to have to raise the rates. And it showed that it's cooling today. That's a good indication that the Fed is done raising rates. We have a couple articles to talk about that. So we have high unemployment rate. That's an indication when you have some people that are saying the job market is still strong. Different people in the Fed say different things, and they give hints of how they're going to vote. But right now it looks like the stock market went up initially because of a soft job report, but we're overbought in general. So there's a lot of pressure for stocks to go down because of that. All right. So what else we have here going on? Okay, that's the biggest news, and there's a lot of hints in the news articles that the middle class are racking up their credit cards, and there's a lot of stress in the consumer balance sheets. That means there's people that are trading down, like this article here, trading down to lower priced items. We had a Dollar General. You'd think that in an environment where there could be a lot of people pinching pennies, that they would, Dollar General teaching, you would think that they would go to Dollar Tree, dollar stores, like Dollar General. Let me see, Dollar General went down like 30%, 20% this week. Another 6% today. Wow. So retail is becoming really, really dangerous. And the economy is is, look at that. It went down like 30%. That's pretty bad. So anything retail right now is not as reliable an investment. Maybe Walmart is the most conservative, long-term, buy and hold retail stock you can buy. Maybe Amazon too. All right, but a lot of these specialty retailers are not doing very good. Let's look at some of our meeting notes. We had 10-year and 2-year down this week, down 3%. And our little formula is as the 10-year goes up, that's bad for the stock market. So, but now that 10 years going down, that's usually good for the stock market. In the job reports, after the job report today, there's more talk that said that the Fed is near the end of tightening, so they might not raise interest rates anymore. Let me see. So we're overbought right now, and you see. Let's look at the. Oh, these are the. Let's see. Moving average charts. I mean, amount of stocks over the 50-day moving average. That's getting better this week. So that means market breadth is improving. And if you combine that with the two 80-plus up-day moves in Monday and Tuesday, that's a pretty good combination for momentum. But right now we're overbought. It's all good to keep these things in mind. You see. Let's take a look at what's going on in the stock market with stocks in the news. We have oil stocks in almost all of them are oil stocks. And we have stocks, Hewlett-Packard Enterprise there, a PE of 8. They have a very low PE ratio. We have top 10 are oil, probably because oil is continuing to go up. And things going down. We have a lot of retail stocks. The theft is becoming a major problem with retail, and it's becoming an unreliable investment. Walgreens, Dollar General, wow. Okay, I'm not really involved in any retail stocks, so I don't really have an indication of why that's happening right now. Let me see. You have a lot of media companies going down, perhaps because the strike in Hollywood. There's not any new movies coming out. It's going to be hard to make their products. So Paramount, Fox, and there's fighting between Disney and Comcast about rights in taking channels off their network, and it's becoming a hugely unreliable. It's becoming a very unreliable type of stock. These media stocks, and the future is pretty much unknown. That's why we were very cautious on Disney. That couple weeks ago, we were looking at that. Disney's like at an all-time 25 or 10-year low. Okay, let's look at some of what's going on in the NASDAQ. Okay, Lululemon. We've been looking at that for a while. For the past 10 years, it's held a really big premium to the rest of the stock market because it was growing a lot. And then during the pandemic, they had a bonus of being a work-from-home stock. So now let's look at Lululemon. They had good earnings that came out, and they gave good guidance. That's a good combination. Let's see what they're up 5% today. Let's look at their statistics just to see if it makes any sense. Okay, so their PE, they've always had a PE in the past 10 years of around 60 to 80. I mean, it's been really high. But now it's down to 32. And you can see that the profit margin is good and the return on equity is good. And they don't have a whole lot of debt. It's $1 billion out of $48 billion, so that's not much. So So the numbers are really good for this company. Let's look at the chart for this and where it's been. So you look at the price is 402. You don't really care what price it is because the price doesn't mean a lot. It just all the statistics they're important. Much like how Berkshire Hathaway never splits their stock, and their stock is like really high price per share. Okay, right now it's in the past, since 2020, 21, for the last 2 years, it hasn't done anything. It's been going sideways. So, let's look at their earnings estimates to see if anything's different there. I'll be very interested in something like Lululemon. They're a retail stock also, so maybe they might go down with the retail stocks eventually. Most stocks that are specialty retailer, they're having really problems, a lot of problems right now with theft and the consumer. Let's look at Lululemon. Okay, so we're looking at just a review of what I look for when I look for a good growth stock. You want this earnings estimates to be going in a straight line up, and when you divide the years over year, you want these to be over 13% growth and consistently going up. Let's look and see if we can find that right now in the Lululemon. Okay. Okay, so the PE is 32. We expect it to be growing at around 32% to be fairly priced. Right now, let's do a calculator. And divided by 11.9. So they're growing at 15%. 5.3, 15%. 15%. Okay, so they're going around 15%. So they're trading, their PE ratio is 32. That means they're 2 times overvalued. I don't know. It's not very compelling to me, and it's involved in retail, and retail's having a hard time right now. So they're not. I don't know. Maybe we'll follow up with this later on in next week or two to see if these numbers are changing. But they did better than expected. But they're still selling at a premium. They've always sold at a premium. So I don't know. Right now, it's not that compelling for me. You can see Yahoo Finance agreed that they're only growing at 15%. So we said the PEG ratio is 2, and Yahoo Finance says it's 1.74. So I don't know. There's a lot of companies selling athleisure, like Nike and Under Armour. So I'd wait for this to go down in half, like the $200 a share. Let's look at this chart to see if it went down to 200 during the pandemic. It went down. Look at that. It went down to 138 during the pandemic. That's whenever it was a PE of 15, and it was growing at 15%. So I guess right now it's at a premium. So I wouldn't necessarily be interested in that right now. It doesn't have like a moat. They charge $80 for something that costs them like maybe $1 to make, and that's a good moat. Not a good moat, but a good markup on what they make. Let's look at some more things we had to talk about during this meeting. Okay, so we're still in we just got done with the worst month of the year. No, one of the worst months of the year, August, and it was bad. It was negative. So our expectations were correct here. September's usually a bad month too, so we're not expecting that to be any better. But so we'll see. All right, the S&P 500. We just went over this. It's overbought. It's halfway between the top channel and the bottom channel. So we could have a little bit more room to go here. We do have a holiday coming up, so it might go up to the top of the channel. But after that, September, we'll have, I expect it to go down because we're overbought right now and September is bad, so it'll probably go down next. Don't get too excited about everything going up now. Oil is up a couple dollars a barrel, up 5%. So you can see all the oil stocks in the sector. I mean, look at the sector ETFs. Change percent. Oil is up. That's the top. And that's probably because the oil's been going up recently. And let me see. Banking ETF is going up. This banking, I'm not sure why it's going up today, but let me see. Energy is the biggest. Energy, home builders are going up. What things going down the most are utilities and consumer staples. Okay, these are usually considered interest rate sensitive stocks. These are paying a dividend, and it's pretty much correlated to the U.S. Treasury rate. And the U.S. Treasury rate, let's see what it's been doing. It's been going down. So if this is going down, then utility should be in higher demand, but it isn't. Let me see. Okay, so oil is becoming let's look at the oil stochastics. Okay, so that's in energy. Put energy. Okay, so energy is in an uptrend right now. You can see it's like towards the top. It's overbought towards the top of the range here. But it's a lot of these stocks in the energy world are paying high dividends and they have low PE ratios. So, and right now there's a potential rebound in the global economy. And there's a lot of people that are saying that next year could be a recession because companies have to refinance and consumers might run out of money. They're putting money on credit cards now and they might not be able to do that next year. So, so if the global economy goes down, the demand for oil goes down and the oil stocks go down too. So that's good to keep in mind. Okay, let's look at, so the oil stocks are going up and home construction. We were talking about, let's look at our map. Last year, or in January, we were saying the home demand returns, possible interest rate cuts. So right now, it seems like home builders, there's a lack of supply in the market for houses because people don't want to refinance into higher rates, so they stay in their house, and there's a big demand for homes right now. And I guess that's why the home builders are up. And of course, the industry was just blessed by Warren Buffett, so that's another reason why the home builders might be going up. Okay, let's look at. Is there any topics anyone wanted to go over? Okay, I'd say that's a no. All right, so I did a screen recently, and I found a couple. Okay, I did this at Fidelity. I just had a couple criteria. The most important things were return on equity, the growth rates, and the PEG ratio. A couple other things. I ranked the top 10 in green and the top 20 in yellow. And then I just kind of looked at, which ones had the most amount of green and the biggest numbers, like 88, and try to figure out some good things to start to look at. And so I put that into some things to start reviewing. Oh, I forgot to say, fair greed index. We're starting to get a little bit more greedy. Last week it was fair, and now we're neutral. So whatever, it's pretty simple, I guess. Whenever the stock market goes up, people get greedy, and when it goes down, people get fearful. So I don't know why we're following this, but you have to think as opposite as an investor. If things are going down and there's extreme fear, you have to be looking for things to buy. And whenever things are extreme greed, you have to look not to buy or to sell. And the dollar is has been going down for the past couple of years, and it's still in a process of going up a little bit. Since last week, it's down, but it's still breaking out of this long-term trend. That's not good for stocks. If this continues going up, then all the multinational stocks we're following are going to report that as a negative thing on the earnings reports. You see, so the VIX is actually at like a multi-year low right now. The stock market went up just a little bit in the last week. Let's look at the action in the last week in the S&P. It went up from here. We were at the bottom of this channel, and now it's went up to halfway. So in that amount of time, people stop fearing, and they stop buying protection. And so with the VIX is like at a really super low right now. So we have some contrary indicators that, you know, if people are not fearful and they're buying and it's overbought, it's not the time to buy right now. And right now, I would say we're kind of right here. We're returning to normal, and you know, people are starting to get confidence again. So we're going to keep our eyes up on these topics right here. Any kind of debt problems usually causes a market crash or major correction outside of geopolitical events. So we have to look at the news articles every day to see if there's any indication that any of these consumer debt problems, commercial real estate problems happen. Because then we'll probably have some kind of sell-off. Right. Let's see. Okay. So we have that job market problem, job market report today that showed there's cooling, and there's some people online saying that the rate hikes are done, and that's really good. If we get some kind of confirmation that there's no more rate hikes, that helps the stock market. But so it looks pretty good that we're done with worrying about this raising the rates. We don't know how long it's going to be kept high. We have more articles about this debt crisis potential. Like these American families are maxing out their credit cards, and they won't be able to borrow more, so they're going to be in a crisis pretty soon, and that could lead to the economy going into a recession. So I guess we look at the banks and the credit card companies to see how the consumer is doing. That's probably good for the bank companies because the banks have what they charge 20% interest on credit cards. What I did was I went through some of these that looked pretty good. You know, they had some good numbers to see if there's any potentials. The first thing I do is I look at their earnings estimates going forward to see if it's any good. And they're a company that sells tractors and farm equipment, and they're probably the largest farm equipment company in America, anyways. And they have high quality merchandise. But I guess you can see the potential things that could make the stock go up are there's still a war in Ukraine, so there's a higher demand for agricultural exports. So maybe farmers in America might buy more of these, machines for their crops. The other things that can make the stock go up. With global warming, you might have to plant more to yield less, and as there's less water for the crops, you have to plant more to yield the same thing. I don't know, but that's I don't see right now these estimates. I just looked at this. That their estimates are. I mean, the earnings are going down from this year to next year, and there isn't much. Maybe 1% growth, and then there's a negative growth the year after. So that makes me not interested in this one at all. I'm not sure why did it show up. Okay, let's look at this. It says PEG ratio. That's pretty much fairly valued. EPS growth 14%. Return on equity 42. Okay, I didn't see the growth part of this at all. So we're gonna not even look at this one. ALB. This is one of Mark's favorite stocks. They Albemarle. They produce lithium and other metals, and let's look at their numbers here. ALB. They're supposedly return on equity is 46%. That's really good, and their cash flow growth rate is 64%. So I said, wow, you got a lot of 32, a lot of top 10 in this. And I said, let's look at that.
And lithium was just in the news. They're thinking there may be a shortage in the coming years.
Really?
Yeah.
Oh, what's your thesis for owning? Do you still own this one, Mark?
Oh yeah, hold.
What's a hold? And
Yeah, I'd say it's a buy, but I already own enough, so I'm not going to buy more.
What's your thesis for this stock?
My thesis?
Your thesis meaning there's a long-term demand for lithium. It's growing.
Yeah, lithium. As electric cars get more popular. And...
Mm-hmm. Okay. And I guess as America becomes more self-sufficient, that they'll maybe fund or give some money for development of lithium production in America. Because we're counting them right now out of China and maybe Chile, a lot of other companies for lithium and rare earth metals and other items needed for EV development. But maybe that's the other catalyst. Could be maybe the government funds some kind of development of activity in America for these kind of metals. All right, yeah. So right now I see one little, from this year to next year, the earnings estimates are going down. I don't know why that's true, but let's look at years going out. 23, 32 divided by 25. 7% growth after that, 25. Then 25% growth from 25 to 26. So it's a little bit inconsistent. They are what's known as a dividend aristocrat. So they've been raising their dividend consistently for over 20 years. So not only that our screen says it was a growth stock, and it had a lot of the elements for a growth stock, but on top of that, it does pay a dividend. So with the growth and dividend, and the dividend will grow over time. But I'm just worried about this. Why the earnings would go down year over year? Maybe they're investing in maybe a new mine or something. I'm not sure. But so that's a little sketchy right now. Maybe this will fill out after a while, and we will understand why it's going down and why they're not earning more next year than this year. Another one that's on this screen is Booking Holdings. Let's look at where that is. Okay, right here. I rank these based on how big they are. Right now, the market cap is like Google is at the top, and it's bigger. But this is Booking Holdings is still a pretty big company. It's a $110 billion company, and they do travel reservations online. But you can see their numbers are really good. I'm looking at this. The PEG ratio is 1. That means they should be fairly valued. So they should be. So what I did is I looked at their their earnings estimates going forward. You can see between 22 and 23, that's really good, but that's like a one-time, maybe pandemic, people going back to normal, one-time only thing. But I did the other years, it's still 30% from the pandemic to this year, not from last year to this year, and then it's 15% after that. So let's say if you average all these out, maybe 22%. Like P is 22, and they're growing at 15%. So their PEG ratio is 1.46. And we mentioned last week or a couple weeks ago, this whole industry could be a disruption candidate. Could it be replaced by, you talking to your generative AI chatbot and get something made for you? I'm not sure, but right now the estimates are only so it's growing at 15%. It's 1.46 times overvalued. So it's not that compelling of a stock right now to buy. But it was a good exercise to go through and see if it was worth it. You can see Yahoo Finance says their PEG ratio is 0.86. So they're saying that they're growing at 30%. I guess what Yahoo Finance is doing is they're using last year's growth rate as their growth rate. They think they're going at 30%, and the P is 22, and then your PEG ratio is 8.86. So, but their profit margin is really good. Return on equity is really good. So everything checks out except for they're not really growing a whole lot. It's pretty expensive for a company that could be displaced. All right, so there's another company on here. I looked at, where is it? ASML. Okay, so I looked across the board here. We had 50% ROI. We had 80% return on equity. So these are all really good. EPS growth of 20%. So I said, let's look at that, ASML. And let's look at they are a supplier, I think, for semiconductor industry. So let's look at the profile. This is the best way to really understand a stock if you don't know anything about it. Yahoo Finance, and then the profile section. It says, develops, produces, sells advanced semiconductor equipment systems consisting of lithium. Okay, so they make systems that allow chip makers to make chips. So they're a supplier. Now, they could, I don't see AI anywhere in here, but if they do supply something for that industry, that is red hot right now. And if you connect the two, that could give this kind of stock a premium. So let's look at the statistics. Okay, so their statistics, their PEG ratio is 1.5. Let's see if that matches what we're seeing. Okay, so ASML, we have, these are the growth rates if you calculate the growth between the years. So if they're growing at 18%, their PE is 32, then their PEG ratio is 1.7. That's not really compelling for me. And the problem with this whole industry, the chip industry, is it's very fickle. These earnings estimates aren't that reliable because companies, they order bunches at once. Just like, for instance, if you're the car manufacturer, you don't want to get caught without chips again. So you're going to pre-order a lot. That might make it seem like it's really great. But that one-time order, they pre-order, and then there's going to be some bad quarters. And this whole industry with chips is very fickle and prone to going up and down in major ways. So I don't think Warren Buffett would invest in these kind of stocks because they're not as reliable and predictable, and this is I guess you can call it a cyclical company. Cyclical is whenever it goes up and down with the economy and how good the economy is going. And so demand, it's really hard to say. It's really hard to give estimates on chip-related stocks. So, but it was a good exercise. It doesn't seem like it's undervalued, so I wouldn't be interested right now in buying that one. Okay, let's look more. Okay, let's look at more what's going on with the sectors. Let's see. Okay, what's going on right now in the stock market? Right now we're like kind of flat. I think the majority of market participants are looking at this chart here, knowing we're overbought. We're kind of hitting some resistance, and it's kind of going flat. But we do have a holiday coming up on Monday, so usually that's good. People get excited going into a weekend like today. Weekends are kind of interesting because if we look at the meeting notes, okay, so weekends, there's a lot of traders that get rid of their inventory before a weekend. So that could influence trading for selling to happen. But we do have a holiday, and we try to think of holidays as positive for the stock market. So because there's less volume and there's actual people feeling good of having a day off. Now, what else can you talk? Hold on for a second. Okay, let's look at some of the stochastics on the stocks we're following. You can see we're in an uptrend in most of these sectors. Let's look at the stocks now. Okay. Okay, this is a AbbVie. They're a stock that basically is growing around 10%. They have a 4% dividend, and they're oversold. And what I'm going to do is I'm going to look through all the stocks. We're going to look right here and see where the stocks are, is overbought or oversold. I can see a majority of these stocks being overbought right now. You can see that Google's overbought. This is in a really big uptrend. And so Altria is up, is overbought. Amazon is oversold, but most of the stocks are overbought. Apple is this tear up. And we do have some defined support in almost every one of these stocks. And let's hope it doesn't break. Because these are the stocks that are leading the market right now, the big tech stocks. AT&T. There's two things to look at with AT&T. There's the sideways pattern that's been going on for a couple years now, and we're basically at the bottom of this. It's been a downtrend, but still we're in this pattern where it's yielding like 8% right now. You see, let's look at Bristol Myers. It's one of the stocks that isn't doing too good in earnings estimates. Let's look at that just for fun. The PE is 16 now. That's really low. That doesn't look really good. I mean, they're not growing at all. So they're growing just a little bit between this year and next year, and then I'm going to calculate that. %. That's 3%. Then minus 3%. Okay, so that's not that. I mean, this is on my list of stocks to stop following because it's turning out to be like a loser stock that's going to go sideways. All right, so I would right now it's in a downtrend, and I don't see it getting out of that. Let's look at Colgate. This is kind of a reliable dividend stock. It's going back and forth between that channel, and it's oversold. You see, CSX, there's no catalyst for rail stocks right now other than the economy. And so I think it's going to go sideways in this pattern for a long time. JP Morgan is at the bottom of its channel and it's oversold. So this is usually a good time to buy that kind of stock. Same thing with, look at that, Meta is at the bottom of its channel and it's halfway between overbought and oversold. Microsoft is overbought. Pepsi is at the bottom of its channel and overbought. I mean oversold. And let's see. Interesting. Verizon's falling, AT&T down the drain. It's going down. It's overbought right now. Visa and MasterCard have the same chart. They're going up and they're overbought. And Waste Management is in a reliable sideways pattern. It's oversold right now. And Amgen is oversold. They just had an article came out today, Amgen, that they can take over a drug company, so that was cleared. So that's probably a good catalyst for the stock. And they're oversold. And CVS is way oversold, and it keeps going down. This is like one of the worst chart patterns that you can see. You can see it's lower lows, lower highs, and on top of that, it's super oversold. Let's see. Johnson & Johnson is like a dividend-paying stock, stuck in this trading range. And Walmart is one of the most reliable retail stocks, and it's super uptrend. It's overbought right now. And the Tractor Supply is actually still in, no, Berkshire Hathaway. It's in an uptrend. This is, wow, this is one of the best performing stocks in the stock market right now. It's overbought right now, though. And MasterCard, it's basically at an all-time high, and they're overbought. So I'd wait for it to go back to here if you want to get into that one. And eBay is going sideways. It's turning into a dividend stock. It's not really a growth stock anymore. I thought I bought it for being a growth stock, but now it's becoming a flat. Let's look at eBay. Look at their earnings. I don't think they're growing anymore. Okay. So their PE is 18. Let's look at their growth, see if they're actually growing. Growing a little bit, not a whole lot. 4.18 divided by 7%. 7%. 6%. Okay. It's becoming a stock that's like a dividend stock. They're not growing. They're going 6%, maybe 7% total return. I'm losing interest in that one. It used to have a monopoly. I guess that monopoly is going to be. They had a patent for auction, but online. But I think that patent could be expiring pretty soon too. That's a bad thing. Okay, so let's look at. Okay, eBay. This with Bristol Myers on the way out for me in my portfolio. It's overbought right now, so if someone's looking to sell this, it's a good time to start looking to do that. Boeing is kind of sideways. They have quality control problems. It's really hard to understand how much that affects people, what people can pay for it. Tesla, look at that. It's in an uptrend. It's super overbought right now. So it seems like the major leaders of the market, big tech stocks, they're all overbought, and most of them are like halfway between overbought and oversold. So there's a good chance all the big tech stocks are going to correct and go back to oversold, and maybe it'll go down to here and then go up to there. So NVIDIA is at an all-time high. No, it's not an all-time high, but a year high, and it's super overbought. so this is not the time to get into the video. Let's see. Let's look at NVIDIA just for fun, because the earnings estimates actually have been going up since last week. Statistics. P ratio is 117. It's different everywhere you look, so it's really hard to get an understanding of this. Statistics. So oh, look at that. Forward PE is 47. So it's grown at 47% next year. Next year is going to be growing 40%. So it's like fairly valued right now. It's like the PEG ratio 1. If you look at the so it could be considered to be inexpensive. Let's look at that NBTA. Okay, so it's grew 300% from 23 to 24. That's this year to next year. Then it goes down to something like 15%. So I don't know. It made a huge run. It's overbought. The time to buy NVIDIA is when it gets down to here, and whenever it's oversold, and eventually that will happen. Okay, that was a good exercise. Is there anything anyone wanted to go over? Okay, one more thing I wanted to look at. There's another stock here that was in our screener. It's Enphase. This is one of Mark's favorite stocks, and I'm going to look at it again just to see if the numbers are filling in yet. ENPH. It seemed a little overvalued last time we were looking at it, but sometimes estimates catch up with the stock. Still waiting for that. Okay, let's look at its P ratio is 32. That's not that bad. Earnings. Okay, let's look at the earnings. We expect 32% growth. Let's look at it. 5.28 divided by 6.62. 25% growth. 6.62 divided by 8.65. 25%. 8.65 divided by 9.21. Okay, so it's growing like 25% for the next couple of years. And its PE is 32. So it's basically right around their fair value. That's interesting. But look at that. Look at their chart. You can see, look at their chart. They're right at their lows from last year in January. And then there was support 5/7/2021. Okay, so you have a lot of support at this level. You can see right there, right there. So there's a very good chance this is going to like bounce right there. I'm not sure. Mark, do you know why it's been going down a lot recently?
No, this is just a very volatile stock. It goes up,
Yes.
it goes down.
Okay, but you're still a believer in the
Long
the
term,
stock,
yeah.
long term. Okay.
Yeah.
Yeah, that's pretty cool. That's yeah. Look at all that support right there. That's what prior support. That will help, the stock bounce from where it is right here. So it's basically fairly valued right here. It's growing at 25%. Its P is 32. So, I guess the themes for this stock could be, there's potential government action to make subsidies for these kind of activities in like California, and in other states to make for ESG. And one problem with this industry, I don't know, I'm just trying to understand it. One problem could be a lot of this activity is on credit. So if you get this product, you're going to pay over a couple of years. Like no one can pay for like $30,000 install of solar panels on their roof, but the consumer is already strapped with all these credit card problems. That could be why, one of the things why it's going down so much, because could be a lack of demand in the next year of financing. Consumers don't want to get into more debt and finance a rooftop installation while they're reeling from credit card debt. That's why we're keeping track of all those credit card reports on customers. I don't know. I think that could be one of the major reasons why the stock is down. But we'll keep an eye on this one because it's looks like it's a decent growth stock, and it was in our screener. Look at all these numbers: 67, 65, 650. These are really good numbers. So just a little bit overvalued right now, maybe 10 or 20% overvalued, but it's definitely a stock that's an ESG related. They could get help from the government. Anyways, all right. I think that's all I had for today. Thanks for attending. I appreciate it, and I hope you have a good weekend, holiday weekend, and I'll see you next time.
Thank you, Greg.
Thank you, Greg. Have a good long weekend.
All right. Thanks.
I'm going to Kansas City to watch the soccer game tomorrow.
Oh, nice. Enjoy.
Very cool.
That's a noise.
Nice. Well, enjoy that, and
be safe.
Be safe.
Yeah, be safe. Yes, that's right.
Bye.
All right. Bye.
Okay.